put your phone or device aside and immerse yourself in this audio story. Perfect for listening on the move, while relaxing, or for bedtime listening. We release new stories daily, so make sure to like and subscribe to not miss out. This story is based on true events. The 72-hour execution. In March 2023, a bank that had survived 2 world wars, the Great Depression, and countless financial crises, vanished in 72 hours. Credit Suisse, a name that once commanded reverence in the world's most exclusive boardrooms, collapsed so suddenly that even veteran bankers stood paralyzed in disbelief. But here's what they don't want you to know. This wasn't a sudden death. This was a carefully orchestrated murder, carried out over decades in shadowy conference rooms, through whispered phone calls, and beneath the polished veneer of Swiss banking prestige. What you're about to hear is the story of how greed, arrogance, and a culture of secrecy destroyed an institution that was supposed to be indestructible. And the darkest part, the people who saw it coming did nothing to stop it. The year is 1856. Switzerland is building railroads, and a young banker named Alfred Escher sees an opportunity that will change everything. He founds Schweizerische Kreditanstalt, Credit Suisse, to finance the nation's industrial revolution. Within decades, the bank becomes synonymous with Swiss excellence, discreet, conservative, unshakable. For over a century, Credit Suisse is where Europe's old money sleeps soundly, where titans of industry park their fortunes, where secrets are kept and empires are quietly built. The bank's reputation is its greatest asset, a reputation for stability that money simply cannot buy. But beneath the marble floors and mahogany desks, something is changing. By the 1990s, the world of banking is transforming. Wall Street investment banks are making obscene profits through aggressive trading, complex derivatives, and risk-taking that would have horrified Credit Suisse's founders. The executives in Zurich watch their American competitors get rich while they stick to their boring, conservative banking. And slowly, like a poison seeping into groundwater, a new culture begins to infect Credit Suisse. The bank decides it wants to play with the big boys. It wants Wall Street profits. It wants to be a global powerhouse. What it doesn't realize is that this ambition will sign its death warrant. The first major crack appears in the year 2000, though almost no one notices it at the time. Credit Suisse acquires Donaldson, Lufkin, and Jenrette, a Wall Street investment bank, for $12 billion. On paper, it's a brilliant move, instant access to the lucrative American market, a seat at the table where fortunes are made overnight. But what Credit Suisse actually acquires is a Trojan horse. The Wall Street traders who join the bank bring with them a culture that is the exact opposite of everything Credit Suisse stood for. Aggressive risk-taking, corner-cutting, a hunger for bonuses that eclipses any concern for long-term stability. The Swiss bankers in Zurich try to maintain control, but they're outmaneuvered. The Americans are making too much money for anyone to ask uncomfortable questions. And so the culture war begins. Old Swiss conservatism versus new American aggression. And slowly, inevitably, the Americans win. Then comes 2008 and the financial crisis that nearly destroys the global economy. Credit Suisse survives, but barely. The bank takes a bailout from the Swiss government, a humiliation that would have been unthinkable just a decade earlier. But here's where the story takes its first truly dark turn. Instead of learning from near catastrophe, instead of returning to the conservative principles that kept the bank safe for over a century, Credit Suisse doubles down on exactly the behavior that almost killed it. The executives decide the solution to their problems is more risk, more aggressive expansion, more chasing of quick profits. It's like watching someone who nearly died from drug addiction decide the answer is more drugs. And the entire financial world watches in stunned silence as one of Switzerland's most respected institutions transforms into a reckless gambler. By 2012, Credit Suisse is operating like a machine with no brakes. The bank is caught helping wealthy Americans evade taxes through secret offshore accounts, a scandal that results in a $2.6 billion fine from the U.S. Department of Justice. For any normal bank, this would be a wake-up call. For Credit Suisse, it's just Tuesday. The fines are paid, a few executives are quietly shuffled around, and the machine keeps grinding. Because here's the secret that no one talks about. At a certain level of banking, crime becomes just another line item in the budget. You break the law, you pay the fine, you keep making money. It's not a deterrent, it's a cost of doing business. And Credit Suisse has calculated that the profits from playing dirty far exceed the occasional penalties. But the real darkness is just beginning to emerge. In 2014, a Credit Suisse banker named Patrice Lescaudron is found dead in his Paris apartment. The official ruling is suicide. In 2018, another banker, Iqbal Khan, is involved in a bizarre spying scandal where Credit Suisse hires private investigators to follow him through the streets of Zurich after he announces he's leaving for a rival bank. The CEO claims ignorance, but no one believes it. The paranoia, the secrecy, the sense that something rotten is festering inside the institution, it's all becoming impossible to ignore. This is no longer a bank. This is a sick organism consuming itself from within, and everyone can smell the decay. March 2021. Wall Street is hit by a financial explosion so sudden and so catastrophic that veteran traders compare it to a bomb going off in the middle of the market. A family office called Archegos Capital Management, run by a former hedge fund manager named Bill Huang, suddenly implodes, vaporizing over $10 billion in a matter of days. The collapse is triggered by massive, highly leveraged bets on tech stocks that go spectacularly wrong. Banks across Wall Street scramble to dump their positions, but they're fast enough to escape with relatively minor wounds. Every bank except one. Credit Suisse is left holding the bag. While other banks are selling, Credit Suisse hesitates, paralyzed by indecision and catastrophically bad risk management. By the time they finally move, it's too late. The bank loses $5.5 billion in a single week. $5.5 billion. Gone. But here's the part that should terrify you. This disaster was completely preventable. Archegos had been operating with insane levels of leverage, essentially gambling with borrowed money on a scale that should have triggered every alarm bell in Credit Suisse's risk management system. But those alarm bells had been silenced years ago. The risk managers had been sidelined, ignored, pushed out of decision-making processes because they were getting in the way of profits. And here's where it gets even darker. Credit Suisse had already been warned about Bill Huang. The man had previously been banned from trading in Hong Kong after being convicted of wire fraud at his previous hedge fund. Every responsible bank knew to stay away from him. But Credit Suisse saw him differently. They saw a client willing to pay massive fees, willing to take on massive leverage, willing to generate the kind of trading volumes that produce huge bonuses for bankers. So they looked the other way. They ignored the red flags. They silenced the internal voices, screaming that this was dangerous. And when it all came crashing down, they acted shocked, as if no one could have possibly seen this coming. It was a lie, and everyone knew it was a lie. But the lie was easier than admitting the truth. Credit Suisse had become a bank where greed trumped everything else. But Archegos isn't even the worst of it. While the bank is still reeling from that disaster, another scandal erupts, one that's been festering in the shadows for years. Greensill Capital, a supply chain financing firm, collapses spectacularly amid allegations of fraud and deception. Credit Suisse had sold over $10 billion worth of funds linked to Greensill to its clients, marketed as safe, conservative investments. They were anything but. The funds were backed by questionable loans, inflated valuations, and in some cases, invoices for goods and services that didn't even exist. When Greensill implodes, Credit Suisse clients lose billions. Retirees, family trusts, conservative investors who trusted the bank because of its reputation for safety. All of them wiped out. The lawsuits begin immediately. Clients accuse Credit Suisse of knowing the Greensill funds were toxic and selling them anyway. Internal documents leaked to the press suggest that the bank's own risk teams had raised concerns about Greensill's business model. Concerns that were ignored by senior management because Greensill was generating massive fees. Once again, the same pattern. Warnings ignored. Risk managers sidelined. Profits prioritized over safety. And once again, it's the clients, the people who trusted Credit Suisse with their life savings, who pay the price. The bank's reputation, already damaged, is now in free fall. The aura of Swiss banking prestige that took 165 years to build is disintegrating in real time. By late 2021, Credit Suisse is hemorrhaging money and credibility. The stock price is collapsing. Clients are pulling their money out in droves, billions of dollars fleeing to safer banks. Credit default swaps, essentially insurance against the bank's collapse, are spiking to levels not seen since the 2008 financial crisis. The market is starting to whisper a question that would have been unthinkable just a few years earlier. Could Credit Suisse actually fail? Inside the bank, panic is setting in. Executives are holding emergency meetings, consultants are brought in to design turnaround strategies, and a revolving door of CEOs and chairmen try desperately to restore confidence. But it's like trying to stop a tsunami with a beach umbrella. The rot has gone too deep. The trust is broken. And in banking, once trust is gone, everything else follows. February 2022. A massive data leak hits the press, and it's devastating. An anonymous whistleblower provides journalists with data on over 18,000 Credit Suisse accounts, revealing decades of the bank's darkest secrets. The files, collectively known as the Suisse Secrets, expose how Credit Suisse held accounts for dictators, war criminals, drug traffickers, human rights abusers, and corrupt officials from around the world. We're not talking about a few bad apples here. We're talking about a systematic, institutional willingness to do business with some of the most dangerous and morally bankrupt people on the planet, as long as they had money. The leaked files include accounts linked to Egyptian intelligence officers accused of torture, money connected to Venezuela's state-owned oil company during a period of massive corruption, funds traced to human traffickers operating in the Philippines. Credit Suisse held accounts for the sons of former Egyptian dictator Hosni Mubarak, for associates of the brutal Angolan regime, for businessmen connected to Pakistan's intelligence services. In many cases, these relationships continued even after the individuals were publicly exposed, even after international sanctions were imposed, even after the evidence of their crimes was undeniable. The bank knew exactly who these clients were, and they didn't care. Credit Suisse's official response to the Swiss secrets is a masterclass in corporate doublespeak. They claim the leaked data is old, that they've since improved their compliance systems, that they take financial crime seriously. But the damage is done. The world now sees Credit Suisse for what it really became. Not a respectable Swiss bank, but a financial laundromat willing to clean blood money for anyone with enough of it. The Swiss banking mystique, the discretion, the privacy, the careful stewardship of wealth, is revealed as a convenient cover story for something much uglier. And the clients who remained loyal to Credit Suisse, the ones who believed the bank still operated with integrity, now have to face a terrible question. What does it say about you if you trust your money to a bank that willingly does business with monsters? Throughout 2022, the situation grows increasingly desperate. Credit Suisse announces restructuring plans, attempts to raise capital, replaces executives, promises reform. None of it works. The client exodus accelerates. In the fourth quarter of 2022 alone, clients pull out over $100 billion, an amount so staggering it defies comprehension. Think about that for a moment. $100 billion. Fleeing a bank that was supposed to be a safe haven. It's not a loss of confidence. It's a complete collapse of confidence. And once that happens to a bank, there's no recovery. Because banking, at its core, is built entirely on trust. A bank holds your money and promises to give it back when you ask for it. The moment people stop believing that promise, the bank is already dead. It just doesn't know it yet. By early 2023, Credit Suisse is a zombie institution, technically still functioning, but fundamentally already gone. The stock price has fallen over 90% from its peak. Employees are updating their LinkedIn profiles and sending out resumes. Clients are making contingency plans for when, not if, the bank goes under. And then, in March 2023, the final domino falls. Silicon Valley Bank collapses in the United States, triggering a panic about banking stability that spreads across the Atlantic like wildfire. Credit Suisse, already on life support, is hit by a massive run on deposits. Clients withdraw billions in a matter of days. The Swiss National Bank tries to provide emergency liquidity, 50 billion francs pumped in to keep the bank from imploding immediately. But it's like trying to fill a bathtub with the drain wide open. The Swiss government realizes they're out of options. If Credit Suisse fails in a disorderly fashion, the entire Swiss banking system could be at risk. Pension funds, insurance companies, businesses, all of them have exposure to Credit Suisse, and a messy bankruptcy could trigger a cascade of failures. So they make a decision that would have been unthinkable just months earlier. They force a shotgun merger. Over a single, frantic weekend in March 2023, Swiss regulators broker a deal for UBS, Credit Suisse's longtime rival, to acquire the failing bank for 3 billion Swiss francs. 3 billion. For a bank that was worth nearly $50 billion at its peak. It's a fire sale, a humiliation, a complete destruction of value. The deal is announced on Sunday, March 19th. By Monday morning, Credit Suisse as an independent institution no longer exists. 167 years of history, erased in 72 hours. Shareholders are nearly wiped out, their holdings essentially worthless. But here's the truly dark part. $17 billion worth of Credit Suisse bonds that were supposed to be secure investments, are completely written off to zero. The bondholders, many of them sophisticated institutional investors who believed they were making safe, conservative investments in a systemically important Swiss bank, lose everything. The Swiss government literally changed the rules in the middle of the crisis to allow this to happen, and the message it sends is chilling. In a crisis, the rules don't matter, your investments aren't safe, and the people in power will do whatever is necessary to protect the system, even if it means sacrificing you. In the aftermath, the investigations begin. Swiss authorities, international regulators, journalists, all of them digging through the wreckage, trying to understand how this happened. And what they find is a story that should terrify anyone who trusts their money to large financial institutions. The collapse of Credit Suisse wasn't caused by a single mistake or a single scandal. It was the result of decades of systematic mismanagement, cultural rot, regulatory capture, and a complete abandonment of the principles that once made the bank great. The executives who presided over this disaster walked away with tens of millions in compensation. The risk managers who tried to sound alarms were ignored or pushed out. The regulators who were supposed to prevent this kind of catastrophe were either asleep at the wheel or complicit in the fiction that everything was fine. And here's the lesson that the financial world learned from Credit Suisse's death. Reputation takes centuries to build and days to destroy. The Swiss banking mystique, the idea that Swiss banks were somehow safer, more trustworthy, more competent than everyone else, turned out to be an illusion. Credit Suisse wasn't brought down by external forces or bad luck. It was brought down by its own choices. The choice to prioritize short-term profits over long-term stability. The choice to ignore risk in pursuit of growth. The choice to do business with criminals and dictators because their money spent just as well as anyone else's. The choice to cultivate a culture where asking difficult questions was career suicide. Every single scandal, the tax evasion, Archegos, Greensill, the Swiss secrets, was a symptom of the same disease. Institutional arrogance combined with a complete loss of moral compass. The fall of Credit Suisse is a story about what happens when an institution forgets what made it valuable in the first place. For over a century, Credit Suisse's greatest asset wasn't its balance sheet or its trading floor or its global network. It was trust. Clients trusted the bank to be conservative, to be prudent, to put their interests first. That trust was worth more than all the aggressive trading profits and Wall Street bonuses combined. But trust is fragile, and once you start chipping away at it, once you start making exceptions, cutting corners, justifying questionable decisions because they're profitable, it begins a process that's almost impossible to reverse. Each small compromise makes the next one easier. Each ignored warning makes it more likely that the next warning will also be ignored, until one day you wake up and realize that the institution you work for, the institution you've given your career to, has become something unrecognizable, something hollow and rotten that's only still standing because no one has pushed hard enough to knock it over yet. Today, the Credit Suisse name is being quietly erased from buildings around the world. The iconic blue logo is coming down, replaced by UBS branding. The thousands of employees who worked there are being absorbed into the acquiring bank or shown the door. The clients who stayed loyal to the end are being migrated to new systems, new account numbers, new relationship managers. It's as if Credit Suisse is being deliberately forgotten, scrubbed from history like an embarrassing mistake that Switzerland would prefer never happened. But the lessons of its collapse shouldn't be forgotten, because Credit Suisse isn't unique. Right now, at other banks, in other boardrooms, the same dynamics are playing out. Ambitious executives chasing growth at any cost, risk managers being marginalized, regulators being captured, cultures of compliance being replaced by cultures of profit maximization. The next Credit Suisse is already out there. It's a bank that looks solid on the outside, but is rotting from within. It's a bank where the people making the decisions have convinced themselves that the rules don't really apply to them, that they're smarter than everyone else, that this time will be different. It's a bank where warning signs are being ignored because they're inconvenient, where short-term thinking has completely displaced long-term prudence, where the culture has shifted so gradually that no one noticed when it crossed the line, from aggressive to reckless to actively dangerous. And when that bank fails, and it will fail, everyone will act shocked. They'll claim no one could have seen it coming. They'll blame external factors, bad luck, unprecedented market conditions. But it will be a lie, just like it was a lie with Credit Suisse, because the signs are always there for anyone willing to look. The real tragedy of Credit Suisse isn't just the billions of dollars lost or the thousands of jobs destroyed or the clients who trusted a name that turned out to be worthless. The real tragedy is that it didn't have to happen. At every stage of its decline, there were people inside the bank who knew what was happening, who tried to raise alarms, who understood that the institution was headed for disaster. And they were silenced, sidelined, or shown the door. Because the truth is, institutions don't fail by accident. They fail because the people running them make choices. Choices to ignore reality. Choices to prioritize their own enrichment over the institution's survival. Choices to believe that the rules of gravity somehow don't apply to them. And by the time everyone realizes how wrong they were, it's already too late. The machine is already falling, and all that's left is to count the bodies and sift through the wreckage looking for someone to blame who isn't standing in front of a mirror. Credit Suisse survived the world wars, but it couldn't survive its own ambition. It weathered the Great Depression, but collapsed under the weight of its own greed. And in the end, the bank that was supposed to be too big to fail, too important to collapse, too prestigious to die, simply vanished, erased in a single weekend like it never existed at all. 167 years, gone. And somewhere in Zurich, in a boardroom that no longer bears the Credit Suisse name, someone is making the exact same mistakes all over again. Because that's the thing about greed and arrogance. They never learn. They just find new hosts. Subscribe and listen to our next story below.